In this class, we continue our discussion on economics, and the last topic under economics is macroeconomics. First of all, I would like to explain what is macroeconomics. It is different from microeconomics in terms of the scope. Right now, macroeconomics, the focus is on the economy as a whole, and our workings or our discussion for macroeconomics include the overall or aggregate demand for goods and services. Next, the output of goods and services. That means the national output, or some countries name it national product. The supply of factors of production. If you remember, in microeconomics, we have the factors of production, including labor, including land, including entrepreneur, and including capital. So we have the factors of production in microeconomics, but here we talk about the supply of factors of production in the whole economy. And then total incomes earned by providers of factors of production. That is the, say, just mentioned about the labor, the capital, and also the entrepreneurship, the land, and the income. We talk about wages, because we have labor, the factor of production, we have the wages for income, and for land, the factor and the income is rent, and for the factor is capital, and then the income is interest. And for entrepreneurship, as a factor, and the income for entrepreneurship is profit. We talk about national income. And the fifth point to be focused in macroeconomics is the money spent in purchasing of the national product, or what we call national expenditure. And last but not the least is the government policy, or what we call here is the macroeconomic policy. So here we have 6 focuses on the economy as a whole for macroeconomic studies. So now we talk about macroeconomic policy, or the government's policy. Most governments intervene through various macroeconomic policies, and the purpose is to attempt to improve the performance of the economy. So we have the objectives of those policies. First, the focus on economic growth. Governments would like to see the economy is growing. That means the productivity or the productive capacity of the economy increased. Another objective of macroeconomic policy is low inflation. It ensures the price level is on a stable level, is sustainable, without any big changes in the price level. So it's one of the policy objectives. Next, high employment. Many governments would like to see people getting into the job market. So as many people into work as possible, then the high employment is one of the government policy, the macroeconomic policy objective. And the fourth one, or the last one, for macroeconomic policy objective is sustainable balance of payments. It means that the economy as a whole can manage trade with other countries on a sustainable way. Next, we talk about the level of business activity in an economy. The overall level of activity in an economy can be predicted by some key factors. First, aggregate demand. And here, aggregate demand. Next, consumer confidence. So it measures how confident of the people or the citizen in the economy. Next, capital. And the fourth factor is government policy. And the fifth element is exchange rate movements. The last one is technology and education. And we will go deep for each of the key factors as below. The first factor I would like to explain to you is aggregate demand. There's an equation. Before going into the equation, let me explain to you, to measure an economy, whether the growth or no growth, there's an equation, is the measuring the total demand for a country's output, or what we call aggregate demand. Aggregate demand equals to C plus investment, or I, plus G means government, plus, with the blanket, X minus M. So here, let me explain to you one by one. Here for C is government as consumer spending for C, and for investments by firms we name it I, and for government expenditure or government spending we put it G, and for X is the exports, for M is the imports. So you can see the elements under aggregate demand equals to, there's a consumption or the consumer spending in the investments from the firms or companies, and then is the government spending or government expenditure, which is G, and then the difference between export and imports for the economy. If a higher demand, it can result in firms increasing output, for example, hiring more staff to meet the demand, so leading to growth in the economy. So when we talk about the economic growth, the aggregate demand is growing, so the output, say the staff or other factors will be increased to meet the demand. Then it is a growth in the economy. The next one is consumer confidence. This factor is the degree of optimism that consumers or businesses feel about the state of the economy and their own personal financial states. For example, if higher consumer confidence, that means they are willing to spend more on goods and services, and it leads to a growth in the aggregate demand. Another example is the business confidence. If business confidence is getting higher and higher, it will result in increased level of investment in new factories and machineries, or increasing more outlets and shops that also increase the aggregate demand. On the other hand, confidence can be reduced by a number of factors, such as high unemployment rate, high inflation, or any natural disasters. The next factor is capital. For capital, it means that whether the economy have greater availability of finance. If yes, it will allow businesses to raise the funds that they need to expand or invest. And this will therefore tend to increase the aggregate demand. For interest rate, if the interest rate is lower, it will make capital cheaper, also tending to boost investment by businesses. And next factor is government policy. Governments can increase or decrease the level of aggregate demand in the economy by adjusting their fiscal policies. Don't confuse between the macroeconomic policies and fiscal policies, because if we talk about fiscal policy or the government spending and taxation, it means the tools by governments to adjust the economy by using its expenditure, the government expenditure, the spending, or the government income. That means the taxation. If higher tax rate on the economy side, the business activities will be slowed because the people are more conservative in spending because of high tax rate. So government can adjust the economy by changing the people behavior, no matter it's the consumer behavior or the firm's behavior in the investments. The fifth factor we discuss is exchange rate movements. If a currency is getting stronger and stronger, it will make a country's exports more expensive, but imports will become cheaper. So imagine in our equation is x minus m, that means the export minus imports. If in this case exports more expensive, that means the x in the equation will get smaller because you are expensive to export to the other markets. Then the customer in other markets will buy the goods from relatively cheaper countries' exports. So if your currency is getting stronger and stronger, your exports will be decreased. And for imports will become cheaper, then it increases the imports as well. So in the equation, the x minus m, that means the number will get smaller if your currency is getting stronger. This would tend to reduce the aggregate demand of the economy. So here, that's why a strong currency will hurt the economy in such a way that the aggregate demand will be reduced. And the final factor we discuss is technology and education. We have new technology, we have more efficient way to work. All these can improve the business productivity and lower costs. With higher productivity and lower cost, it thereby increased the business output. And higher levels of education can also improve the efficiency and effectiveness of the workforce. So a lot of governments in the world, in different countries, the governments would encourage or has the incentive to encourage their people to take more training or education no matter by subsidizing them to do it or not. It helps to improve the people effectiveness or efficiency in the job market. That also improve the business productivity and ultimately improve the aggregate demand. So there are 6 factors that have the impact on the level of business activity in the economy. And now is the illustration time about the factors that influence the level of business activity. If you have a good memory, in 2008, there's a global recession. The global recession in 2008, when it occurs, a lot of people cannot pay their bill because they lost their job. For example, the financial crisis started from US and then Europe. It hurts the global economy because a lot of financial institutions, they don't want to lend the money to different enterprises. And some companies cannot survive because of the lack of liquidity. Then it's a global recession. And for United Kingdom, the governments did 2 things in order to solve it. First, the VAT, the value added tax reductions. During the global recession, the UK government temporarily reduced the level of VAT down to 15%. This has the effect of making the consumer happy, so they would like to purchase cheaper goods or increase their confidence, and meaning that wages were able to buy more goods. So cutting the VAT, that helps to improve the consumer's confidence and also buy more stuff. At the same time, the central bank in United Kingdom, or what we call the Bank of England, started to reduce the interest rate. And it's not just reduce the interest rate gradually. It do it quite significant to lower the interest rate. This was an attempt to make it cheaper for business or for businesses to borrow funds to keep their business running or even to expand if possible. The additional investments by the businesses that this caused was also designed to boost aggregate demand. So on two sides, the government in UK, in United Kingdom helps to boost the economy under the global recession in 2008. The in-class question time. There are two statements. So which one or which of them is correct? So first statement is changing the level of taxation is the only way that a government can affect aggregate demand. And the second statement is a weakening currency could provide a boost to the aggregate demand of a country. So which one is correct? For the first statement, if a government, whether it's the only way to change or affect the aggregate demand, do you think it's the only way? Is the taxation or any other way? And next is about the currency. Remember, there's equation for the aggregate demand. The one of the components of the aggregate demand is export minus import. So for an economy, if the currency is weakening, whether it is positive to the aggregate demand of the country or negative. So here I give some clues to you and hope you can answer the question.